Mike Franklin is Head of Global Investment Strategy at Beaufort International, joins me in the studio now. So, Mike, where's this growth going to come from?
That's a very good question. I think that's what's troubling the world at the moment. I'm actually encouraged by some of the news coming out of the States.
Right.
China, of course, has been a big engine of growth, and we're seeing some slowdown there. I think what we can conclude at the moment is that Europe is not going to be the source of growth. So that is where the difficulty is going to rise. I mean, there are a lot of austerity programs coming through, and, you know, it's going to be tough.
Why are you encouraged by the situation in the US? Because obviously what we see in Europe, the developments here, always front and center when we look at the markets, but it seems as though, actually not just this week, but for a couple of weeks now, the US and the budget situation there is just creeping into sentiment in the markets, and a lot of investors are actually very concerned.
No, I think that's right. I think you could say that the Obama administration has actually hung. And I don't mean hung in the sense that it's well hung, it is hung in the sense that it is neutered. And, you know, this could be a problem for markets for the next 12 months. Having said that, we're in very volatile conditions. There are opportunities to make money if you get your timing right. And I think because you've got the balance between fear and greed, you know, that is going to keep the markets very active. At the moment we're having a sell-off, we've got a bit further to go, even if we try to consolidate on the way down. But at some point we're probably going to get quite a good rally, maybe before the year end.
But do you find that with all the volatility you describe, we are seeing perfectly healthy businesses being sold off for no good reason?
Yes, that is a danger. I mean, it's an interesting point with the whole M&A issue as well. That well, just coming back to the markets, as you say, markets being sold off, stocks being sold off. There's value there which is being discarded. But then you've got to look at the position of the investors that are holding those assets, and they have their own agendas, and in some cases they need cash. Regardless of what they're holding. So you very often see this in markets, that good quality situations are sold down along with the bad ones. So the discrimination to some extent has gone out of the window in terms of individual stocks. And what's more important is to get the market timing right and enjoy the flows when they come in.
Right. You say cash is king right now.
Yes.
And a lot of people would disagree with that because they'd say, well, actually, if you look at the interest that you're getting on cash, well, it's next to nothing when you compare it to the dividends that you could make on some of the companies that are actually doing quite well.
That's a fair comment, but the thing is, you know, the level of interest that you get is a relatively short-term thing. It's nice over the period of a year that you get that return, but when you look at what markets have done over the last, well, since the beginning of the year, you've got some very sharp falls in markets. I mean, even the S&P 500 is down about 5%. So, you know, you don't want to chase income just for the sake of it. You can lose a lot of capital along the way. So I think, you know, you've got to bear that in mind.
Interesting data compiled by Bloomberg News actually shows that stocks in emerging markets are actually trading at levels 35% cheaper than their 15-year average. I'm just wondering, where do you stand on that, Mike? Do you see growth advantages and cheap stocks out there?
My take on emerging markets is, yes, you know, I mean, you look at China, the problem is that they pumped in a lot of money a couple of years ago, 3 years ago, and against that background, they're now starting to reap some of the problems of that. You're having to go in on a premium to a lot of those companies. The ideal is to go into the companies perhaps quoted in the West, which are being sold down, which are actually trading in these higher growth economies. So you're going in via the back door. You know, maybe companies like, you know, a couple that have been named recently, sort of Burberry and Porsche, you know, they're high margin companies.
Are you investing in those companies?
Good brand names. That's the sort of company we'd be looking for, basically, yeah. You know, even B-Sky B, actually, as a matter of interest, has actually held up remarkably well for a whole host of reasons. It's got good earnings flow at the moment, but that could suffer. But
do you think there is any danger to those companies with exposure to emerging markets? Interesting comments from Citigroup saying that China's economy will moderate in the coming quarters as property investment slows and export growth eases.
I think the problem when you look at somewhere like China is that it's a vast economy. It's not very transparent. And even today in the press, you've seen comments about what's going on in the property sector. Perennially, there are problems in the property sector, apparently. It's a question of where the dislocations arise. And I think investors have to be aware of that. They have to be very tuned to what those changes are going to be.
All right. Well, thanks very much indeed. Mike Franklin, Head of Global Investment Strategy, Beaufort International.